Yeah, a couple just very high level items is like it's not imperative that you invest in the market where you live. You can buy properties outside of the market you live in a market that's performing well. If you live in Baltimore, Maryland, and it's not looking so good where you're at, or you're in Northport, Florida, and there's negative 10.7%, appreciation, which is depreciation. They don't like to call it that. You might want to invest into an area that is appreciating. So, very quick free tools you can use online. Zillow has a home price appreciation index. Uh, they have a website. You can just type in the zip code, and you can see if that area is going up in value or down in value. And it's easier to fix and renovate or build a property in an area that's going up in value, because if you spend more than you thought you were going to on the renovation or the construction, which happens, right? Uh, they think that they say the sure things in life are death and taxes. I think the other ones, Craig, is that construction prices always go up. There's always inflation on everything, so things are always costing more than you think. So investing into an area that's going up in value is important. Uh, and you know, I think net migration is another one. So if you look at where moving companies like U-Haul, where people are moving themselves, that might not be, Bridgeport, Connecticut, but people are moving themselves into, a lot of markets, and you can see where net migration exists and where job growth exists. Um, you know, ChatGPT can give you some pretty good rundown on, net migration appreciation and uh, how the market's performing. And then also, I think it's very important in a mature market to not go outside of your comfort zone too far above median home values. Zillow, again, free index on median home value. And, if you're investing 2 to 3x the median home value, you need to make sure that there's absorption for that sort of a product. There's enough buyers that can afford it. Um, and I think that's generally very important. It's also when you get into that like very dangerous zone of like 1.5 times the median home value, it's always a financed transaction for the end buyer. And the people who can qualify for those loans today on the conventional side can also qualify for a larger home and a nicer home. So they may not want yours. So let's just take an example. Let's just say a small. Let's just take Orlando, where we're both from, right? So median home value is what, 450,000, something like that today. If you have a $750,000 house in your suburb of Orlando, like Winter Garden, for example, it's 1.5 times the median home value. It's the less affordable, less desirable home than if you had something that was 399,000 below the median home value. There's a lot of buyers in the market that can afford to buy that house versus yours, which would have a much smaller pool of buyers. In same scenario, you have a $1.5 million home in a better part of town where everyone's paying cash or can easily afford that, then maybe that's going to sell faster than your slightly above the median home price.